Hello, fellow Rebel Capitals. Hope you're well. I am here once again with my good buddy Chris Irons from the Fringe Finance Substack. Did I get it right, Chris?
Yeah, you did. And
Yeah,
I enjoyed your thumbnail today. It was very demure.
Oh, well, dude, it's not just the thumbnail. Notice?
And there's no hat. Yeah, that's good. And I'm also not wearing a hat.
I'm showing off my incredible hair.
We're showing off what we're made of. We're almost like reciprocals or not reciprocals in math, whatever you call it, like fractions that cancel out. You got it on your head and I got it on my beard. So if I move my head down, we kind of even out.
There you go, buddy. There you go. Well, dude, we got a lot to talk about, man. First and foremost, home sales, pending home sales at their lowest level ever since they started keeping track, which I think was 2000, 2001. And that's not adjusted for population. So obviously population a lot higher now. That's a significant number. So we got to talk about that. Then we've got the jobless claims spike. The number was higher than expected today. Potential softening in the labor market. And then we've got to look at the Fed's recession indicator. So I think yesterday I talked about how CNBC came out now that Trump's in office, and they're saying, oh, the yield curve inverted again. And this is the Fed's favorite recession indicator. And I said, well, it's actually not their favorite. They've got one that they like even better. So we're going to check in on that and see what that is telling us potentially about the underlying economy. So first and foremost, let's get into this story from CNBC, Chris. Pending home sales drop to the lowest level on record in January. So the key talking points here: pending sales dropped 4.6% just from December to the lowest level since the National Association of Realtors began tracking this metric in 2001. They say while the weather may have been a factor, the sales actually rose month over month in the Northeast. So in other words,
weather's always, they always use weather. That's always like, always. And it's not just home sales, it's every other macro indicator. It's retail. They always say it always comes first. It can never be high interest rates. It can never be a broke American consumer. Yeah. It can never be the economy stalling. It's always like, hey, was it raining in Nashville last week? And that's like where we start our economic analysis. It's like mortgage rates are 8%. What are we doing?
Exactly. And then how they point out that month over month sales increased in the Northeast. And so the big decline was in the West, which obviously was not impacted by the weather. If anything was impacted, it would be the Northeast. They basically disproved themselves in the exact same sentence.
Well, it reminds me of a sleazy biotech company that fails its phase 3 trial and then goes in and pulls out some ad hoc bullshit. They data mine essentially for anything that they can say that looks good. Well, in patients who have first names that start with the letter C, who took the medication between 8 and 8:30 in the morning on Tuesday, March 17th, we saw them meet their primary endpoint. It's like, what about the like half the population that died when they took the drug? You know, That's what it reminds me of. Like, hey, there's one town in the West where everything's fine, as like the entire housing market is burning in the background. You know?
Yeah. Like that Leslie Nielsen meme. Okay, the next talking point here: home prices have been easing over the last few months in certain areas, with more sellers cutting prices. Wow. Okay. But nationally, they're still higher than they were a year ago. Okay, year over year, I'm more concerned with what's going on month over month, to be honest. Let's see. We talked about that. Here are some quotes. I'm sure, Chris, you're going to love this. It's unclear if the coldest January in 25 years contributed to fewer buyers in the market. And if so, expect greater sales activity in upcoming months.
Yeah. National Association of Realtors. I mean, like, what possible motivation could he have for not saying, hey, the market's just a nightmare right now?
Yeah. But here, again, they highlight what we just talked about there. While weather may have been a factor, sales rose month to month in the Northeast and fell in the West, which would have seen the smallest impact of cold temperatures. Sales fell hardest in the South, which has been the most active region. So in other words, again, just disregard anything they're saying about the weather. Total nonsense. Then they go on to talk about the interest rates, the mortgage rates being higher. And now they did spike there in January. They came down at the end of January, assuming they followed the 10-year. But then let's remember, more recently, they have plunged, and we'll have to see how that plays out over the next few months. They said this drop in sales also came despite the fact that the inventory home sales in January, including houses that were under contract but not yet sold, increased by 17% compared with last year, growing on an annual basis for the 14th month in a row. So much for historically low supply.
Right. You got more sellers than buyers, and interest rates are high. And it doesn't matter whether it's 7 or 7.5% or 6.75% or 7.75%. To be frank with you, historically, these mortgage rates are very high compared to the last 10, 20 years. And so that's all you really need to know. I mean, not 20 years, but historically, mortgage rates are the highest they've been, probably in the better part of the last decade.
Yeah.
And so,
and Chris, another thing that I see people getting wrong when they analyze the housing market all the time, even experts, is they just hyper focus on the mortgage rate, and they assume that that's the only cost of home ownership.
Right.
So as long as you've got a fixed rate 30-year mortgage, well, then you have nothing to worry about, and you're never, ever, ever going to be forced to sell your home, as if you don't have property taxes, as if you don't have insurance, as if you don't have maintenance costs. So if the overall price of home ownership goes up to the point where you can't afford it every single month, it doesn't matter if your mortgage has stayed the same. You're still in the exact same position. That means you got to force sell. Now, fortunately, a lot of people that didn't buy in the last 3 years have some equity there, so they're not in too bad of a situation. But as more and more that supply comes online, if you don't have the buyers there to pick up the slack, the prices are going to go one way. And I'd point out nominal prices,
right?
Not when you adjust for inflation. Obviously, the prices are a lot lower.
There was a guy on CNBC like 4 or 5 months ago who was talking about, when interest rates had come down slightly, maybe they were at 7.5 and they came down to like 7.25. I don't know what it was, but talking there about how refinancings are going to be a boon for the market and are going to help drive stocks higher. And I'm like, dude, people that are taking on mortgages 2 years ago at 7.5% aren't refinancing at 7.4%. And even if they are, that's not going to give anybody enough liquidity to do anything. It's nonsensical.
Yeah. By the way, how many people are taking out a mortgage on their home to buy stocks?
Well, probably more than we know. To be honest with you,
Unfortunately, yeah. So, and one other thing that I want to remind people that, according to this article, I can't see that they adjusted for inflation or for population. So this is just, it seems to be like a nominal number. Like they're just saying, okay, we had 1,000 pending sales, and that was
go to the header. Oh, pending home sales dropped to the lowest level on record in January. Yeah, so they're talking about the absolute nominal numerical figure.
Yeah, when now we have 330 million people in the United States, and back then we had, let's just say 275 million.
Right. So, well, because in adjusting it for the population would make it look even worse. So they're not going to do that.
Yeah, way worse. Yeah, that's my point there.
They're always going to do whatever can give you the rosiest number.
Yeah, exactly. So this is just something that we've got to pay attention to, because it's not just about home prices. It's how home prices impact the overall economy. Because in my view, we've got this economy that's completely propped up by asset prices.
Right, 100%.
If you do have, and then also higher interest rates. I was listening to Mike Green, who's a good buddy of mine today, and he was making the point that it's not just asset prices with the wealthy. It's also the fact that they have this cash on their balance sheet, whether that's in T-bills or money market funds, and they're getting a substantial interest rate relative to what they've got over the last 10 years. And they have a higher propensity to spend the additional interest they're getting, as opposed to just selling stocks, taking those gains, and then going out to Chipotle. So I think that's a good point. And I want to give credit where credit is due. The first person I heard talk about that was actually Warren Mosler, the father of MMT. And I don't know. I mean, his point was that higher interest rates actually stoke inflation because of that. And I think that's a variable, but I think on net balance, the higher interest rates would likely be more of a headwind for consumer prices. All right, next, let's check out the jobless claims. Yeah. So earlier this week, we were talking about some big events here on the calendar. I always like to use this market watch. And just to reiterate, guys, we had Tuesday, the Case-Shiller Home Price Index came out, 4.5. So slight uptick there. And it's really weird, Chris, that you get this uptick in the Case-Shiller, but all the other news around pending sales and new home sales is all down.
Right. So was it a lagging indicator? I mean, they could all be on different timelines. You could be getting data from January and December. You could be, I mean, there's no end to the ways that they will fuck with the data, the macroeconomic data that they put out also too. So who knows who's pulling what strings and what cross section of the economy we're looking at what given time.
Yeah, that's a great point. The next thing that came out on Tuesday was consumer confidence. This was the Conference Board survey, and we had a huge drop there, way below expectations. The drop was from 105.3 to 98.3, but expectations were for 102.3. So a big, big miss. We've got new home sales that was a miss as well. Jobless claims, that's what we're talking about now. The expectation was for 225, and it came out at 242, which isn't a massive miss, but it's all about, is this potentially going to start a trend where we see the labor market getting weaker than it was before, and a continuation of the SOM rule that was triggered, maybe 6 months ago, something like that.
About that.
Yeah, right around, we're going to talk about how that impacts the yield curve as well, or how those two metrics go into an analysis with the yield curve and kind of the probabilities of an economic contraction. Durable goods. Now, I don't follow this too much, but that was a beat on the upside. And then GDP, pretty much the same. Then here's this crash in pending home sales. To give you guys some context, last month, it was a decline of 5.5%. This month, they were expecting a decline of 1% when we actually got a decline of 4.9. Going back to the weather thing, Chris, if weather was a big deal in January, well, we know about it now in February, what the temperatures were. So that should have gone into the analysts' expectations.
Right.
And they were still expecting a decline of 1%.
Right.
Yet we got the decline of 4.9%. So you
see,
and
it'll whipsaw back in February or March when it gets warmer, if that is the case. But if I had to guess, I would say that this is more so the consumer just not having the ability to buy a house at this point.
Yes. But my point.
And there is oh, sorry, go ahead.
The weather was baked into the expectations.
Right. Correct. Yep.
For the -1, and we still got the -4.9.
Correct.
Yeah, tomorrow is going to be a big, big day when we've got all of these kind of inflation numbers coming out. But let's get into,
especially with the way the market's trading now. I mean, you have PCE, like if these numbers come in hot tomorrow, now you have rising unemployment, you have home sales tanking, you had Nvidia beat yesterday, and then not be able to hold its gains. Like the fucking stock market is exhausted. Like the stock market just feels absolutely exhausted. And so if these numbers come in hot tomorrow, if PCE comes in hot tomorrow, it's just going to solidify this idea that the Fed is completely out of options. They can't lower rates. They can't raise rates. Like there's no way out. So it'll be interesting if the numbers come in hot tomorrow.
Right, but I could make an argument for the opposite too.
Go ahead.
Say the numbers come in soft, and then now the market perceives that as, yes, the Fed will likely cut more than we thought, but that means the economy is slowing down. And if the economy is slowing down, that confirms what Walmart was saying last week. That confirms, Starbucks doing all these layoffs. That confirms what we're seeing in the consumer surveys, the consumer sentiment. That confirms what we're seeing in the housing market. So that, I don't know, it could be, you could make a bearish argument for both sides of that, right?
Yes, I'm much more comfortable waiting for the data to come out and then commenting on it afterwards.
Yeah, for sure. I mean, we have no idea how it's going to play out.
As I try to predict and time things, I've noticed over the last few years that that's not my specialty. Thank you. My subscribers give me some grace with that, which is fantastic because I'm constantly issuing mea culpas and admissions that I'm not a mind reader and I'm not a psychic. I'm much more comfortable looking backwards at something that's already happened and then telling you about it. Yeah, he threw the touchdown in the third quarter,
But actually, let's do that, Chris, because your real job, let's say, was really analyzing the balance sheets for specific companies. It's probably the opposite of what I do. Again, I'm really kind of more of a macro guy, where you're kind of studying the micro, if you will, and really seeing how stocks typically respond to news. I'm sure was a big part of your job. And let's go back to Nvidia, because yesterday they beat expectations, but today, I'm looking at it right here, they're down 8.48%.
Well, that speaks to the valuation, right? So,
so can you
first off, what's that?
I said, please expand on that.
Okay, so first off, going into the report, you have a stock that, and this was the first thing I said yesterday, and you can't hold me on this, and I'm just giving you my opinion, and this is not rooted in any type of fact at all. But if I had to bet, I would say, by virtue of the fact that Nvidia's earnings are so crucial to the overall market right now, that they would be more likely than not to stretch things in a manner that makes the numbers look as good as possible. That is, and I have no evidence of that and no proof, but if I had to say, where is a ripe part of the market where you might pay special attention to, like, revenue recognition or things of that nature, pulling forward orders and revenue, where would I go to look for that? My first, I would say, maybe I'd take a look at Nvidia. Now, I haven't done that, so I have no evidence of that happening at all, but I'm just spitballing here. That's the first thing. Then number two, you have a company going into earnings that has this ridiculous valuation. You're talking about 50 or 60 times earnings. You're talking about 25 times sales. You're talking about, whatever, 50 times book. I mean, so look, when a company goes up because earnings are going up and then its valuation starts to go up as well, the multiple expands, you have this, in essence, big, like, air pocket that forms between the company moving up on fundamentals, but then the more grace that the market is giving it as a result of multiple expansion. And as that delta gets bigger, to come back down to even normal, modest market expectations, you have this big air pocket. And so what we're having here in Nvidia is the market saying, hey, maybe I don't want to pay 55 times earnings right now for this company with the market at its environment, that it's in now, where the economy is right now. And it just shows that, like, to me, it just feels like an exhaustion on behalf of the market. It feels like the market is not only exhausted by the valuations, exhausted by the AI narrative, but also that capital may be exhausted. Like, how much money do we really have? Even the passive bid, how much money do we really have to pour back into Nvidia? You look at something like the passive bid, which is essentially your 401ks and things of that nature, buying ETFs. And as unemployment starts to rise, the passive bid starts to lose a little bit of steam too. Nvidia is part and parcel with pretty much any ETF and fund that you can buy out there. I mean, it's in everything. It's in the S&P, it's in the NASDAQ, it's in the ESG funds, it's in this and that and the other. And so it could just very well be a combination of the valuation compressing and the narrative being exhausted and the capital starting to be exhausted. So what I'm telling you is the opposite of what people on TV are going to tell you, which is they're going to find a case to say it's worth buying at any level, at any level, at any price, at any valuation. What they do is they're fixated on telling you that there's a reason to buy it, and then they have to back into some kind of bullshit explanation as to why it's not expensive here at 50 times earnings or 60 times earnings. Now, I just saw this the other day. I just wrote about it. I was writing about Kramer talking about Palantir and talking about Carvana and a couple other names. And, all of those companies are pretty aggressively valued. And he's on there just saying like, oh, just wait for the sellers to come in and then buy it, as though the valuation isn't even up for discussion. And what you see from the sell side is you see the sell side backing into all these explanations. Oh, my 2035 model says that the company's going to have an entire new segment and it's going to bring in $50 billion of revenue. You start getting into like backfilling your thesis based on just being bullish with stocks at this valuation, and you have a whole bunch of garbage. You have a house of cards of nonsense that just crumbles at the first sign of reality. When you think about the fact that equity markets during times of real recession and real pain often pull back to places like, 15 times earnings. And I think that's being generous. But, I think they've been closer to 10 times. The S&P's been closer to 10 times earnings at that point. But let's just say 15 times earnings. As far as I can see it right now, some of the cheapest tech stocks that I can find, and I mean the cheapest, are trading between 20 and 25. And so what does that mean? It means if we go back to historical norms, these companies could still essentially see a 40% or 50% haircut. And there's nothing stopping these companies from taking a bigger haircut than that if the bid really is exhausted and the economy really does start to contract quickly. And so, I'm not surprised. I was saying yesterday, people should, I don't think the rally is going to last in Nvidia. The valuation is still extremely aggressive. Just people over the last 5-10 years have been indoctrinated into this psychology that valuations don't matter. There's always a reason to buy. The Fed put is always there. And it's just been absurd. The valuations at the bottom of the COVID crash, taking out of mind where the economy was and everything else, just as low as we got during the COVID crash, stocks were still expensive. You could argue that they were still expensive.
Yep.
And the NASDAQ has like tripled since then. So we have, people used to say animal spirits. Well, what is it? It's this bullshit term for risk-taking, appetite for risk-taking in the markets, which is really what it is. But we're beyond animal spirits. We have introduced a level of euphoria and hubris. And most importantly, I wrote about this last week on my blog, the expectation of comfort and the expectation of the market always holding up. So much so that people have become so complacent and so comfortable and believe so much of the bullshit that they hear on TV that the smallest move lower in markets, even this 2% in the NASDAQ today combined with the last couple of days, you add leverage on top of that and you add this psychological, like super thin ice that people are on, and it's not going to take a lot. The quote I used in my piece was to break the brains of market participants, because I think that's what's going to happen during this next crash. People have no clue. We haven't felt real pain economically in this country probably since 2008. And that's like we were on the brink and then we weren't. But that was the last real like big, COVID was a blip on the radar, but it was in 2 to 3 weeks, the market had steadied and the economy started getting back on its feet, through the miracle of creating a shitload of inflation. So if this next crisis rises to the level of, the Fed being in this rock or hard place where they have to choose, lighting the fuse on more inflation versus a real deflationary depression, I don't think people have any idea what, and just for an example, when you leave this stream, just flip on the TV and watch what people are saying about Nvidia, because I guarantee you there's somebody on TV right now saying, "Oh, I'm going to use this. I'm going to use this. This is an opportunity." And I go shopping when it's like this. Things are on sale. It's like, motherfucker, the Schiller PE right now is like 37x, which is like an area we've only been one other time in history, and that was the 2000 tech boom, which was ostensibly the biggest bubble that's ever been blown in the market in history. That's the territory we're in. So don't be fooled by this, like, oh, it's on sale, or like I use these days to go shop. There is a ton of irrational exuberance and euphoria and excess in the markets, and a lot of it is going to have to come in. There's values out there. You have to be judicious when you're picking stocks. But the notion that, oh, we pulled back 2% today, and so all of a sudden everything's at a discount, it's like, check those PE ratios against historical averages. Do your due diligence on the valuation of these equities and the amount of cash that they're generating, and those types of things first, because there's a million people that like to tell you that this stuff is on sale, but
I think it goes back to asymmetry. And I always say there's three things that all great investors have: skill sets. Number one, they're incredible at risk management. Number two, they have an edge. And number three, they place asymmetric bets, meaning that there's far more upside than there is downside.
Right.
The problem here with Nvidia is, sure, the price might go up. It could have gone up today. Nobody can predict that. But what we do know is that it's wildly expensive. And we do know that there is asymmetry, but unfortunately, it's to the downside. It's not to the upside. It's the opposite asymmetry of what you would want. And so what basically happened here is you've got the earnings, let's say, at a 0, and they came out with earnings at a 5, which was a huge beat, but it was so wildly overpriced that the beat would have had to be at a 10 in order for the stock not to go down.
Right.
And then what you see is, if you get that 5, then the stock's down, 8.5%. And just think if they would have missed. I mean, my goodness gracious. If they would have missed, it would have been down 18%.
And look.
And then what would have happened to the NASDAQ? I mean, on that note, the NASDAQ just plummeted at the end of the trading day today. And we finished down 530 points, which is really significant because of what we have seen over the past week or so.
Let me just make a point here. Real quick, because I'm looking at the chat as well too. And I'm kind of like reading the comments as we're streaming, and people are like, oh, QTR's been saying this for 10 years. Okay. How expensive is a 40 PE when you're growing 70% year over year? Right. I get that point, right? That is one of those like arguments. If you're growing net income 70% year over year as a perpetuity, 40 times earnings is not expensive. I completely get that point. It's not lost on me. And I have been saying it for 10 years, except for the fact that when the COVID bottom happened, I did say, and I think on your podcast, that I was in there buying financials. I was in there buying other stocks that looked cheap. Goldman was trading at like 0.8 times book, 0.7 times book.
Fantastic back then too. Let's not forget.
So I'm not afraid of saying that there are things out there that I would buy. Like I bought some Google today, right? Like I'm not Google trades at 22 times earnings, which is relative to the rest of the tech world relatively cheap, and it spouts off a ton of cash and it pays a dividend. So it's in my opinion, a relatively safer name. But anyways, the point is that to say, oh, you've been saying it for 10 years, like if you want the other side of the coin, just put on CNBC. Like it's okay. Like I look at the macroeconomic picture and monetary policy in one way, and people that want to make the argument right now that things are going to grow 70% year over year in perpetuity are looking at a completely different economy than I'm looking at, because I'm looking at an economy that's like on the verge of slowing. and people are talking about 70% year over year growth. So two kind of different things. And
yeah. And another thing too,
to be fair,
go ahead.
Just to be fair, like I have no problem saying like somebody like Tom Lee, whose entire thing is going on CNBC and telling you to buy the dip at any and all points for any and all reasons. I have no problem saying that he has been right and I have been wrong. I have no problem saying that, like, if you've been bearish since the COVID bottom on equities, like you've been wrong. There's, I'm not bringing like ego into this. Like, I don't really care. Like I'm not here trying to be Mr. Finance guy or impress people. The point is though, like the entire industry is awash with Keynesians and modern monetary theorists who have no problem telling you that there's always a reason to buy. And just because I'm not going to like carry that narrative doesn't mean that, it's this big controversy. The point is, like, if you look at the market based on historical means and historical averages, it is expensive. Market cap to GDP, historical PE, Schiller PE, any way you want to slice and dice it. We've had real rates now for the first time in 10 years. Historically, over the last decade, interest rates are significantly higher than they've been. And if you think that that means that this is an environment to go in and buy stocks, then do it. But, I'm not, you can say like, oh, broken clocks, right, twice a day and whatever. But the fact is, there have been many times in the past where I've said that there's equities that are attractive, there's valuations that are attractive. But like the NASDAQ at 37 times earnings right now, going into a slowing economy, like I just don't find that attractive. You can call me, Peter Lynch if you want, a deep value investor, but it doesn't make sense to me.
Yeah, and also too, with that argument, let's just assume that prices do go up. That doesn't mean that your analysis was incorrect, and that doesn't mean that there was no bad news and you were just making that up and you're just pulling that out of thin air. That, oh, what are you talking about, Chris? The market wasn't overpriced. Well, how do you know? Well, because it went up. Well, no.
Right. And this whole thing, this whole thing with like, oh, Nvidia's, growing 70% year over year, which is, I'm guessing, the name that this person is talking about. It's like, okay, like how long can that last? Right. Like we already saw this kind of rumor the other day that Microsoft was backing away from some of, the data center leases that it was considering, even though Microsoft refuted that, which I'm guessing may have had more to do with what it was telling the market or not. But it's like, okay, like, is that going to happen in perpetuity forever? Is there unlimited demand essentially right now for,
And also too, Chris, look, if it was fairly priced, then why on earth is it down 8.5% on a huge beat?
Right.
Just don't take my word on it. Don't take Chris's word on it. Just look at the damn price, for heaven's sakes. The price action today confirms that the 40 times or 70% earnings growth, that was the expectation there was too high, and that it
confirms that it was too expensive yesterday. Exactly. That's what it confirms, and that's it. And then tomorrow it might go back up.
You got it. And so, but the other thing that I really want to reiterate there is when we're presenting things like the housing market, like the yield curve, and we're going to talk about this in just a moment here. When we're talking about the stock market being at a 38 CAPE ratio, when typically it's at a 17, it's not like we're making that up. Like we're not just pulling that out of our rear end here. That those are actual facts. Go
on your screen right now to currentmarketvaluation.com. Just type in currentmarketvaluation.com. It's got like 6 charts right there on the front of the screen.
Let's see here. I don't know if I could just do that. That's it?
Yeah, now start to scroll down, right? All right, so here's the Buffett indicator. Everybody's wondering why Warren Buffett's in cash. Some big fucking mystery, right? The fucking thing is called the Buffett indicator. It's market cap to GDP. It's what he uses to value the market. Right now, it's at the highest level it's ever been. It's over that 2x strongly overvalued line, or 2 sigma strongly overvalued line, rather. and it's at the highest level it's ever been. Okay, so boom, mystery solved. Why is Warren Buffett in cash? It's been this big fucking talking point for 3 weeks. All right, there's the chart. Market cap to GDP. Next, go down. Price to earnings over historical norms. Two sigmas, strongly overvalued, almost at the highest point in history, but for the 2000 market crash. Oh, Chris Irons is insane for saying fucking you should be cautious. Oh, right.
Here we go.
Interest rate model, almost at the historical norm, in between 1 and 2 sigmas, overvalued to strongly overvalued. Oh, Chris Irons is an idiot, right? Growing 70% year over year. S&P 500 mean reversion. I mean, look at this. All right. So anybody that's got any fucking questions about what my reasoning is, all right, can go and type in current market valuation and just look at it. And that's gratuitous because I don't fucking owe anybody an explanation to begin with. I'm just trying to let people know that I'm not coming from this insane place of wow, like the market's trading at an 8 PE and I'm in there I just can't deploy any capital, George. Nothing's cheap enough. It's like this shit's trading at fucking 100 times earnings. And I got people oh, you're out of your mind. You're a perma bear. It's like, whatever. Go fucking watch CNBC if you want the opposite. You know what I mean? Turn the shit off and go put there's a guy on CNBC right now making up 50 fucking excuses about why you should be in there buying some company that has no cash on its balance sheet, isn't generating cash, is laden with debt, and deserves your capital. Go listen to that guy.
What is this that's fairly valued?
I can't fucking read these comments. I have to turn these off.
No, don't, Chris. Just don't read.
It's ridiculous.
Disregard it, dude. They're probably just trolling you anyway. Don't worry about it. So, what is this earnings yield gap? Earnings yield gap. What? I've never heard of this.
That one, I'm not sure. A model comparing the earnings yield of the S&P 500 against treasuries. Okay. Illustrating the relative value of one against the other. So it's the earnings yield of the S&P 500 versus the yield of treasuries. I don't know if they're using a 10-year treasury or what.
Probably. Okay.
But this is the kind of chart that will adjust if earnings start to pull back in the market, which goes to this 70% year over year point. It's if we're going to relive 2024 for the rest of our lives, everything's going to be up 70% year over year earnings wise. But if the economy slows down, that's just not going to happen.
But then look at this one, Chris.
Yield curve model, very high recession risk. What does very high mean, George? Does that mean no risk? I'm new to the markets. What does very high mean?
I just think that means you're a perma bear and you're just making this stuff up, Chris. You're just fear mongering.
Go back and watch my podcast with you. It was the day after Bill Ackman said hell is coming. Yeah. I have an article on my Substack. It's the first article. If you go all the way back to my sitemap on the bottom of my Substack and go to my COVID predictions, it shows right there where I said, okay, financials are cheap. A couple things are cheap here. It's worth buying. So it's not like I'm saying there's nothing to buy. I'm buying emerging markets here. I'd be buying emerging markets. I'd be buying gold miners. It's just what? I'm some lunatic tinfoil hat wearer because I don't want to pay 60 times earnings.
Oh, here, let's not forget about the SOM rule. And so here it says normal, but then you read, normal recession risk.
Right.
And so, okay, we're still at that.
It's on the recession risk high line.
Yeah, right. Margin debt, neutral sentiment.
Yeah, that we know about.
Oh, this is okay, but is this optimistic? I just included this because look at
we were just talking about this.
Yeah, so the last time wildly optimistic, but the last time we were at this level was, oh yeah, that's right, just before the GFC. So I don't know. This is like the unemployment rate where it's always at an all-time low just before you get that big spike, which usually just precedes the stuff hitting the fan. But I think these charts pretty much illustrate your point. And I want to be clear, it's not to say that there isn't some good news out there. There absolutely is. I mean, we got
there it is.
Positive GDP.
Why is Berkshire in cash? People will look at that chart and they will say, why is Berkshire Hathaway in cash? It's a mystery. We can't figure it out.
I know. All right. And let's get back. I think we were originally talking about jobless claims. We got off on that massive tangent, but that was a good one. I think that was definitely necessary.
Chris has been wrong for 10 years. Who cares? What are you doing listening to me to begin with? I'm wearing my pajamas. You know what I mean?
You're too sensitive, buddy. You're too sensitive. All right. So here we go. Weekly jobless claims jumped to 242, more than expected, in latest sign of economic softening. So that's not Chris. That's not George saying that. There you go, CNBC. So if you want to take it up with them. In Washington, D.C., new claims totaled 2,047, an increase of 421, or 26%, the largest number for the city since March 25th, 2023. In other economic news, durable goods such as aircraft jumped. Okay, I think we talked about that. Unemployment claims in the United States.
What does that mean? Is that good? Up and to the right. That's good, right?
I was going to say, I think I see a trend there, Chris. Do you notice anything peculiar about this chart?
Yeah, I hate this industry. I really do. I swear to God, like, I don't even know why I'm doing this. I hate it. I'm not joking, dude. I'm really not.
I'm not laughing at you, my friend. I'm laughing with you.
When you asked me before, you're like, do you want to do the stream today? I was like getting ready to go to the gym. I was like, maybe I should just go to the gym and I'll do the stream next week.
You're in such a good mood too. You're probably in such a good mood.
I really was.
And the blood pressure goes through the roof and you get pissed off. Now you're going to go to rest. Now it's going to ruin the rest of your night.
No, it won't.
All right. Let's see. Fed's recession. Let's go into that, Chris. So have you heard about the near-term forward spread? Do you know anything about this?
No, please tell me.
Okay, cool. So what the Fed did, and I don't know if they actually came up with this metric or not. I don't think they did. But I've read on the Fed's website several times that this is actually their preferred kind of yield curve indicator, if you will. And what it is I'm reading right here, difference between the expected 3-month interest rate 18 months from now minus the current 3-month interest rate. And so this, you would say it kind of corresponds. Well, it definitely corresponds. There's some differences there with the 3-month and the 10-year treasury yield. But this one, to me, looks a lot more accurate because I pull up a 3-month and we can see that there's some uninversions there. In fact, it's quite common. With the 2-year and the 10-year, it's not very common to get a re-inversion, let's say. But here, when we get an uninversion, it's often that we get that re-inversion with the 3-month and the 10-year, which would kind of give you that false positive signal, kind of lull you to sleep, and then boom, you get that right hook from Tyson. Where with the near-term forward spread, is giving the Fed some credit here, it does seem to be more accurate. And what I mean by that is when it does invert, it usually doesn't uninvert until you get the actual recession or just before. So it's a little bit better at the timing, I think is what I'm trying to say. And they used this near-term forward spread 90-day moving average, which hopefully you guys can see represented by this purple line. And when this has re-inverted in the past, which I'm looking at GFC, that means, you're already in the thick of things. And sometimes it doesn't even invert until you're right on the brink. So the question becomes, where are we right now? And including this in your analysis with everything else that we're talking about. And we are still inverted here. So this never uninverted like the 3-month and the 10-year. So I want to really pay attention to this. And obviously, the reason this uninverts and then steepens out really quick is almost always because the Fed dropping the front end of the curve, which is a bull steepener. That's when the front end is going down faster than the long end, as opposed to a steepener, a bear steepener, where let's say Fed funds is the same and the long end of the curve just keeps going up and up and up to a point, let's say where you get to historic average at maybe 1 or 1.5% above the front end of the curve. So bottom line, we've been seeing that bear steepener. And if the Fed is off sides, and let's say they cut more than the 2 or 3 that are expected for 2025, you would likely see this purple line shoot straight up, very consistent with what we saw during the GFC, or let's just say the dot-com bubble bust. What do you think? I'm giving you some wonky stuff here, Chris. What do you think about that?
I think you're right.
Oh, I'm not right. I'm just regurgitating what I'm seeing in the data and what the chart is saying. So if you don't like what the data says, don't blame me.
Right. No, I'm fine.
I think we've broken Chris Irons. We've broken him.
I'm fine.
All right. Well, on that bombshell, guys, enjoy the rest of your
Joe Rogan always says, never read the comments. And so that was my problem. I don't want to. You don't have to cut the show short or anything. Do you have more?
No, we've already gone for 45 minutes.
Oh yeah, no. Usually we go for like an hour. I didn't know. I didn't want you to turn it off just because I'm miserable.
I want to torture you as much as I can. No. I got to get some tickets for this weekend. We got some UFC fight, not actual UFC, but we've got MMA fights down here. In at it's not really a Coliseum, but I want to get off here and get tickets so I can get good seats.
You got to come up here and train with me, in Philly.
Oh, dude, I've never done any type of grappling. I've done a lot of boxing, but I've never done any type of grappling whatsoever.
Can you hold pads?
Sure.
Yeah. All right. Yeah. Well, we can get a workout. You don't need anything to get an hour workout in.
Yeah.
Push up, sit up, squats, and fucking line work and head work, and that's it.
And the best thing about doing a workout with you is there's no comments.
No, well, that was, what? Here's the problem. Last time I figured out how to detach the comment window. And last time somebody said something like, I love Chris. So I read it and I was like, oh, this is great. I can just be, showered with adulation as I'm doing this at the same time, getting like a nonstop dopamine hit. Like, yeah, I don't really know what I'm talking about. I'm a genius, Except today, there was one guy in there who was no, honest to God, I really don't give a fuck what people say. The point is, I'm more arguing the point. The point is that, like, I take personal offense to, like, I think, like, people are insulting my intelligence on television when I watch the same people make a consistent case to buy the market regardless of valuation. And it's intellectually dishonest to me. Like when 90% of your programming is we're going to be bullish and then we're going to back into our content from there. And so the headlines are always, there's a reason to buy. Perfect example, right? Like last year, at the beginning of the year, the banks come out and they set their targets, right? So everybody's S&P target is, 10 to 20% higher than where the S&P is, right? And every year, the S&P overshoots those targets, and there's this big round of headlines in the spring that's like the S&P has already hit Morgan Stanley's target. How fucking brilliant are Morgan Stanley, right? And then Morgan Stanley has to then come out and retroactively change their valuation, their models, whatever they were using at the beginning of the year to justify the market overshooting their target and saying, well, like, all right, it has to go up. So you see this on the sell side a lot, right? For people that don't know, when you read sell side research, when you read a note from, one of the big investment banks, they are predominantly 95 times out of 100 not going into that with an objective frame of mind. Their goal, for the most part, is to do investment banking business with the company. They want to be the book runners on the next financing. They want to be the company that handles the next strategic transaction. And so it behooves them, and they want to stay close to management. So it behooves an analyst to make nice with the CFO, make nice with the CEO, and then go out and put out bullish commentary on a company. So they take whatever the company line is. Hey, we've figured out a novel new way to make frozen yogurt in outer space. And they take that line and they don't do any due diligence on it and they parrot it back to investors, right? And so when you're in that frame of mind, the idea is if at the beginning of the year you set a $20 price target on a $10 stock and it hits your price target, to continue to provide bullish research and higher price targets, you have to retroactively go back and engineer some type of bullshit that justifies a higher price target, when in fact the first price target probably wasn't justified to begin with. There's a lot of good companies where this does happen and it is justified, but there's a lot where it isn't. And so similarly, in a situation like this, if you had told market participants 2 years ago that the S&P is going to be at 5,800 now, a lot of them would have said, that seems a little fucking excessive. You know, that seems like a little too much. But now that we're there and people can't come out and say, we expect a 5% drawdown or we expect X company's stock to go down because they want to still be friendly to them and they want to be friendly to getting on television. So you get the little thing on the bottom that says blank securities and everybody knows, hey, I'm the fucking analyst from so-and-so bank. In order to do that, they must retroactively go back and now do some mental gymnastics that makes a valuation like 60 times earnings or 100 times sales or 200 times sales make sense. And that's where I think the intellectual dishonesty comes in. And I've been around long enough to see that. And I've done enough work with equities on the short side and on the long side to have a feel for, you know, the environment. And the only thing I'm trying to do is provide a 5% counterbalance to an industry that is 95% awash in optimism. And it just so happens that everything is aggressively valued now. And it's a point where optimism, maybe, I don't even want to say not warranted. How about I just say less warranted than it was, you know, 10 years ago. And so that's all I'm trying to do. I'm just looking.
It's also true that their number one priority as an analyst is going to be to keep their job. And
of course,
if you get it wrong, as long as everyone else gets it wrong, then you're still going to keep your job. But the problem is if you go outside of the herd and then you get it wrong, then you're going to get the axe.
Right.
So this is just this kind of pro-cyclical, it's a self-reinforcing process. And maybe that's why it takes so long for the bullish narrative to change. That's something we talk about here, where the data has to become so blatantly obvious. It has to be so right in their face that we are in a recession because the stock market's gone down by 50%, that then it's safe for all the analysts to come out and say, well, I don't know, things don't look too good. I think our expectations for the S&P 500 are down 5% for the next year. It takes it to go down, you know, the S&P has to go down by 50% in order for it to be safe for them to go ahead and say that and not risk losing their job. Is that a big part of it?
And then, yeah, that is a big part of it. But then you also have to remember that if you wake up one morning and things are all of a sudden different, right? Because things have a way of changing very quickly and when you least expect it. Say we wake up tomorrow morning and the fucking market is limit down. You know, not going to happen. But let's just say that happens, right? It's going to be a mad dash to, you know, first off, there's no fucking accountability, right? So everybody who's on TV today telling you to buy is not going to be held accountable if you know, and all I'm saying is use caution. So no one's going to drag these people back on TV and say, oh, you were saying to buy the market, you know, a couple of days ago, you fucked up. You should never come on again, or explain to people how you could possibly miss it, right? It's like Bernanke saying subprime is contained. The thing is, everything changes quickly and sharply, and then everybody's looking around like, how could this have happened? Who could have seen it coming? When, you know, I'm not saying, oh, give me credit, because I don't give a fuck. I honestly don't. I'm just saying that it is right in front of your eyes. Do your own research. It's right there, you know? And again, I'm not saying go out and buy puts on the market and go crazy. Just use some caution. That's the whole point.
What's even more frustrating, Chris, is if we do get, let's just say, a bear market, down 20-25%. All the people that were wildly bullish, including Tom Lee and Jim Cramer, are going to come out and say, "Oh no, I was bearish." That's like with the GFC, right? Like nobody was calling that except for like Schiff and a couple other guys way out on the fringe. But yet after the fact, in 2012, 13, all these experts are saying, "Oh yeah, well, I called it. Well, I called it. Well, I called it." And it's like, where's your receipts, bud?
More so, yeah, exactly. And more so is they often will find something like the weather or like COVID or the LA fires or the Russia-Ukraine war. They'll find something and they'll pin it on it. I can go back and read annual reports over and over and over again from 2020 to 2022. And you had these dog shit companies that were not generating cash and had terrible businesses and were performing terribly prior to COVID. And every one of them has COVID as the reason that they're failing in their 10K that next year. So, don't let a great excuse go to waste. And there's just one more person I want to respond to. This guy says perma bears are never accountable when they tell people not to buy before the market rips to the moon. And what I'll just tell you is this, okay? I can't think off the top of my head where a time that I said, don't buy, and then the market just went crazy, where I specifically try not to tell people what to do. I just give my opinion. But I'll be accountable. I'm the first one to say that Tom Lee has been right thus far, and I have been wrong. So if you have been short the market since the COVID bottom, you got killed. Even though
let's be clear, Chris, he's been right on the price. He hasn't been right on the asymmetry. So it's all about what your priorities are as an investor. If your investor is what direction is the price going and looking back in the rearview mirror, then you're absolutely right. But if your priority is making asymmetric bets, then you can't dispute what Chris is saying. Just look at those charts that we just went over, and that tells you everything that you need to know.
Well, and it's not just like this other guy says that's because bulls are right 70% of the time, even though I think it's more than 70%. It's not just because they're right all the time when the market goes up. It's because they're afforded a buffet of bullshit excuses when they're wrong, too, where it's the complete opposite. If you are a skeptic or you're looking at the market in, a cynical manner or an Austrian manner, it's the opposite. We're pushing the rock up the hill, which means we're right, 10% of the time. And we're not afforded excuses when we're wrong. We're assumed to be wrong. And then when we occasionally, things go in the way of our thesis, then we're cast as the bad guys.
Yeah, but I wouldn't say that you're right 10% of the time if what you're saying is that the market is overvalued.
Right.
Like even if the market goes up, if you're saying that it's in a bubble, that doesn't mean that you're wrong.
Well, you have to listen to these people
the absolute facts. But you cannot dispute the fact that the CAPE ratio is at 38. So just because the market goes up for the next year, it doesn't mean that it's not overpriced right now. So
right. And this plays to a whole line of narratives that started, 5-10 years ago, where people were saying, is the market just different now? Is 40 new the historic? Is 40 times earnings the new historical average? Are things different? In the age of modern monetary theory, in the age of Keynesian economics, is 40x earnings the new 15x earnings? And that is I just see that as another way of kind of retrofitting a thesis. And look, Ron Paul said to me on my podcast a year or two ago, he said, listen, the free market kind of always has a way of sorting it out eventually. And I truly believe that will be the case. And you can call me wrong or right or whatever you want. It doesn't matter. Like you're saying, the facts are the facts. Historically, the market cap to GDP indicator is the highest it's ever been. That's a fact. That's as solid as his desk right here. Do with that what you'd like. Is it does it mean nothing because markets have had a paradigm shift? Maybe. Does it mean we're wildly overvalued? Maybe.
Yeah, I mean, we'll just close on this. I would challenge anybody to go back to any of your podcasts and point out something that you said that wasn't factual when you're talking about valuations and things.
Don't say that.
Well, but when specifically referring to this topic, right?
Right.
All right. So tell us about Fringe Finance. It is, you go to Substack, and I don't even know how Substack works. And then you just type in Fringe Finance and it comes out.
It doesn't matter. I'm too tired to promote my shit. I
You don't
say,
even want anybody to go there because you're so mad at the people in the stream. F them all.
yes. Don't go to my blog.
I don't even want you as a customer.
It's going to be more of this stuff that everybody seems to hate, and I can't keep the comments on next time.
All right, guys. Enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism.
Big kiss to all your commenters. Big kiss to everybody.